Good morning, everyone. Welcome to Daily Rates Live with the Mortgage Calculator. Today, we're going to talk about 40-year amortization loans after we go through our live rates. So great topic here for today, something we haven't talked about in a very long time. So good topic here to go into. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. We appreciate those of you tuning in nice and early. And it looks like we're live on all the different platforms already, so we'll go ahead and get it started here. We'll take the chat off the screen for now, but go ahead and keep dropping comments in there. Drop any questions you have in the chat as well that we can answer for you here today. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every weekday at 11 a.m. Eastern on this show is go through our actual live rates for that day, and then we do a deep dive into a different loan type. Today's loan topic is going to be 40-year amortization loans. So Jose will take us into a deep dive into that here shortly. But before that, we'll do what we do every morning, which is pull up our rates. So Nick, if you're ready, let's go ahead and pull up today's pricing and see what it is looking like.
All right. So a lot of volatility in the markets here. So we'll check this out. Looks pretty much the same as yesterday, but we'll pull up our rates for today. It is May 30th, just after 11 a.m. Eastern. So all of our standard programs have new rates for today. We're going to compare the APR across all the programs with a basic scenario. We'll set up a $500,000 purchase price, $400,000 loan amount, which corresponds to 80% loan to value, 20% down on payment, an estimated 760 credit score, and an estimated 40% debt to income ratio here for all of our demos. When we get to the DSCR demos, we'll use a value of 1.5 for the DSCR, which I'll explain when we get there. Now, if you'd like a full breakdown of all the fees that go into these quotes here, itemized loan estimate, please get with our team members. We have over 300 loan officers to help you out. Now that I've given my speech, let me go ahead and share my screen. All right. So for our rates today, the first option we typically look at for most customers looking for a primary home is our 30-year fixed conventional option at the top left here. Rates as low as 6.875 today. Final APR comes in at 7.185, which is about the same as it was yesterday. We were lower than 7 for a while there, and we recently ticked back up. Hopefully, we see that go back down here. Now, if for any reason our customer doesn't qualify for a conventional option, the next option we want to typically quote and present is an FHA option. FHA allows more leniency on credit issues, as well as a much higher debt to income ratio overall. And FHA comes in today at 6% rate. Final APR 6.97 when you include all the upfront and yearly mortgage insurance that is required. So if you compare these on the APR, the FHA could be a touch cheaper if our customer qualifies for both. And if our customer needs to use FHA, definitely a good option. As in today's example, it's actually a touch cheaper than conventional. So a good option for our customers that need to use it. Now moving on to our VA option. So for our eligible vets and active service members, if you are eligible, the VA programs are amazing. Rates today come in as low as 6.124. Final APR 6.414 there with any funding fees and stuff included. Notice that the APR for VA is much lower than FHA or conventional, so definitely a great benefit for our customers that do qualify. And final option on our list for agency government is our USDA options. Remember, these can only be used in properties that are in USDA eligible areas, which is typically our rural areas. So make sure you check out that map and make sure your customer qualifies. But for our customers that do, these options are great. 5.99 rate today. Final APR 6.760, which includes all of the fees. So we can compare that across FHA, which is typically what the customers looking in those USDA areas will be comparing, and comparing it to a conventional. Notice that USDA APR is cheaper. So definitely probably the best option for most of our borrowers that do qualify and are looking in those areas. Now that's it for agency government. So if our customer doesn't qualify for any of those standard 4 options, most other banks or lenders will have to deny them as they have no other options. But that's where we love to come in and present our 5,000 plus additional options here. So first up for our more options is our non-QM alt doc primary. So typically this corresponds to a bank statement program is typically the lowest rate option here. We also have P&L, which we went over yesterday, 1099, asset-related programs, all kinds of different options here. Lowest rate option for alternative documentation today, 7.125 rate. Final APR, 7.343. So notice it's within just 0.25 actually today of conventional. So if our customer for some reason doesn't qualify conventional, needs to use alternative docs, this is actually very comparable today, especially as conventional went up a little bit. Non-QM is relatively the same. So great option for our customers that need to use those alternative docs. Now moving on to our investors. First up for investment property, non-QM alt doc for investments. Again, typically a bank statement or similar option. Rates today for that come in at 7.5. Final APR, 7.806. And we'll compare that to our other investment options. So the only agency government option is conventional. Remember, government programs, USDA, VA, FHA do not work for investments. So the only option we have here is our conventional 30-year fixed for investment coming in at 7.5 rate. Final APR 7.855. So it's just a touch higher than our non-QM option. So definitely very comparable here for our borrowers that need to use it. And moving on to our favorite programs, the DSCR. DSCR stands for debt service coverage ratio. No income, no employment is needed. We simply use the estimated rental income from the appraisal to determine a DSCR value. If the estimated rents can cover the expenses, aka the property cash flows, that's a ratio of 1 or higher, which is preferred. For these demos, I put a ratio of 1.5 so we can see all the programs pop up. So first option here is our 3-year prepayment penalty. That is the most common. Rates today come in at 7.374 and a final APR of 7.714. Beating conventional. Absolutely amazing to have a DSCR option beat conventional. And most investors will still take a DSCR option even if it's more expensive than conventional. So definitely recommend our investors check these options out. And to sweeten the deal, we can add a 5-year prepayment penalty. So if we add a 5-year prepayment penalty, rates today come in at 7.125, final APR 7.432. And moving on to our final DSCR option here is with no prepayment penalty. So rates today with no prepayment penalty, definitely a little bit higher. So 7.999 rate, final APR 8.513. Notice that's higher than conventional for our customers that do not want a prepayment penalty. So usually recommend our investors try to go for one of these 3 or 5-year options that are showing better rates. And next program that shows up here, we'll go over 30-year fixed second mortgage for a primary home. Definitely very popular request as people want to get cash out from their homes, but do not want to do a cash out refinance and refinance their low first mortgage. So we can add a second mortgage for cash out, rates as low as 9.625, final APR 10.113 for our customers that want to keep their first mortgage. Jose did a show on that yesterday where we calculated the blended rates. Definitely check those out. And another bonus option here, 40-year option for DSCR. We have all kinds of variations. This is just one of them, 40-year fixed DSCR with a 3-year prepay. Comes in at 7.75, final APR 8.058 for our investors that want to maximize their cash flow. So a 40-year amortization obviously will lower the payment and therefore increase our monthly cash flow for that rental property. So some great options here, but let me go ahead and get into today's topic, which is going to be a deeper dive into our 40-year options. As I mentioned, those are typically for our investors that want to maximize the cash flow there because the payment is lower. But there's all kinds of tricks we can do on the 40-year. Very common trick is interest only, a very common add-on for 40-year. All kinds of variations we can do in the non-QM world. That's why we have so many programs, because just a regular DSCR program can have hundreds, if not thousands, of different options as we add 40-year amortization, interest only options. We can add different prepayment penalty options, all kinds of variations here when we get into the non-QM. So Jose, let's check out some of these 40-year variations so we can get into the ways our investors can capitalize.
All right. Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Like Nick said, definitely we've had a lot of volatility. Today, the volatility is down. I just looked at the 10-year right now, and it's down 7 basis points. We're at 4.55, and I'm actually seeing that movement materialize in our non-QM options. I'm going to have some very choice nuggets for you today. Looking at what we have here, our rates are actually beating conventional for these very outside the box options that we have here. We compare conventional investment, which is full doc, 30-year amortization, no interest only, and some of the options I'm going to present to you here are blowing it out of the water. So please note that the 40-year amortization is an option only for non-QM loans, right? It's not an option for agency, FHA, USDA, not an option, just non-QM only. So showing you some full doc options first, just to show you the progression of the rates for interest only and non-interest only, because I am showing you 40-year amortization, and I'm breaking it down to some 40-year interest only options and non-interest only options. Now, keep in mind, the reason you're usually going to select this amortization is going to be qualify for the loan, right? The DTI, if we're doing a non-DSCR loan, maybe slightly over the limit, or maybe the borrower just wants a lower payment. But usually you're trying to structure the loan to meet the mark, right? Stay under the threshold that you need to stay under. And the good thing is that the 40-year amortization stretches out the payment to 480 months as opposed to 360 months. So you are going to have a slightly lower principal amount to your payment, right? Because you're stretching it out over some more 120 more months. But on the flip side, you are going to have additional interest expense. And keep in mind that the amortization schedule is front loaded so that the majority of the interest is paid in the beginning rather than in the end. So you are going to have some more interest expense there. However, if it is what is needed to make the loan happen, then, like I like to say, 100% of nothing is still nothing if the loan does not close, the borrower does not get to meet their objective. So let me show you. Oh, and the other thing is on the interest only, you got to make sure that if you are going that route, review the guidelines and make sure that that particular conduit where the loan is being submitted will let you analyze the debt to income or the DSCR, depending on what loan type you have, based on the interest only payment. Because in some cases they offer the interest only option, but it's just for the borrower to pay interest only, but they still qualify you on the fully amortized non-interest only, quote unquote, payment. So our first example here is 90% LTV, which is a max for all non-QM loans, regardless of income type. 90% is the max, and never any mortgage insurance on non-QM loans. So for our 90% LTV full doc, 40-year amortization, non-interest only, you have 9.625 is at par, and you can buy that down all the way to 8.25% at a cost of 2.375 points. Now, the next example I have here, and let me keep this up like this so we can see it and compare, because the next example I have is adding interest only to the same exact loan, right? So this is a comparison I want to make, because if you're really looking to have the buyer qualify, make sure you really need the interest only component, because the difference in payment is not that much in the end, and the interest rates are higher, because here you're looking at 9.75 with a cost of 1.125 points, and you can buy it down to 8.875%. So let's look at here now. 8.875 has a payment of $33.28. That should be our interest only payment. And then if we come back over here, 8.875 fully amortized has a payment of $34.28, and 8.875 here is costing you 1.125, whereas 8.875 here is costing you 2.375. So you got more than double the cost for the rate, and your actual savings in payment is about what, $100, I think, 34.28. Yep, exactly $100, and that's just because you don't have to pay principal. So you're not really saving anything. You're just deferring the principal payment for a while, for 10 years. If you stick with that loan for the whole 10 year, then also be aware that a 40-year interest-only loan, after the interest-only period is over, then converts to a 30-year fully amortized payment loan. Right now, whatever you owe gets recast as a 30-year loan, and you're going to make the full payments, and now the payment's really going to go up, and you have all that deferred interest that now comes into the mix, and you're going to have a much higher payment. So definitely not a loan to stay in beyond the amortization period. Oh, I think I am momentarily frozen. Give it a minute. There we go. All right. So I really wanted to make that comparison there so you can see, only use the interest only if you really need it. I mean, in this scenario here, rather than go interest only, right, 2.375 cost. So we can go right back over here. 2.375 cost gives us 8.25% rate. So we're still 40-year amortization, but now we don't have interest only. This is our cost. We're at the same LTV, and now we're at 32.14 on our payment instead of 33.28. So do we really need the interest only in this case? I would say probably not, but I like to throw it out there and let everyone make their own decision. And this is the kind of comparisons you have to give to your borrowers as well, because they may not know, right? They may think, interest only, yeah, I'm going to save hundreds and hundreds of dollars. So now we have our 85% LTV. So I wanted just to show you the progression. Now I'm going here with just 40-year amortization, no interest only component. 8.875 is at par. In the other option, non-interest only, 90% was costing us 1.125. So 8.875, and we can go all the way down to 7.75 at a cost of 2.375. So definite improvement as we drop the LTV to a more traditional 85%, and then the more standard 80% LTV, same option, full doc, primary, 40-year amortization. Look at these rates. 7.875 is at par. Wow. And you can take it down to 6.99. This is definitely competing with agency, and this is our full doc option. We haven't gotten to our DSCR options yet. And now we got a bank statement option, and I'm mixing it around a little bit here. So this one is primary purchase, 90% LTV with interest only. And our cost increases a little bit on the 9.75. Our cost increases to 1.625, and you can buy it down to 9.125 for 90% max LTV, interest only. So now we're going with investment. So on an investment, 85% LTV is the maximum LTV. And I'm maintaining the interest only component here. And we are looking at 9.75 as our lowest cost option, costing 0.5 point. Notice that got a little bit cheaper than our full doc because this one has a prepayment penalty. And we can buy it down to 8% at a cost of 3.5 points for our non-QM interest only, 40-year amortization bank statement purchase at 85% LTV. Now, here's where it gets really exciting. I'm definitely seeing some movement in secondary. I think whatever money's leaving agency in secondary is definitely coming to DSCR because we're seeing guidelines definitely expand and loosen up, because now on our 85% LTV DSCR, we have a 40-year option, 8.499 is our lowest cost option at 0.625 points. And you can buy that down to 7.125. I can remember in the not too distant past that this 85% LTV DSCR with a 30-year amortization was at least 1 to 1.5% higher than these rates that we're seeing right now. So take advantage, investors. By the way, there is not an interest-only option for this 40-year 85% LTV. I guess that was just too much risk for secondary to swallow there. And now our non-QM 40-year amortization. Again, this is non-interest only, and now we're at 80% LTV. And look at that. Look at that, Nick. I think we beat conventional there, and we're at 40 a year. We're at 6.75% interest rate as our lowest cost option. This is with a 5-year prepay. And at 7.875, we are at par. So totally amazing 40-year amortization DSCR. And our last example here is our 40-year amortization, 80% LTV with interest only. All right, let me scroll down a little bit here and look at those rates. We added interest only, increased our lowest rate option, and increased it from 6.75 to 7.125. So we increased 0.375 to get interest only. Lowest cost option here is 8.499. So very interesting here. And let's look at the payment difference a minute. So 7.125 non-interest only is 25.22, costing us 1.5 points. 1.5 points here gives us 7.999 at 26.66. So, and the 7.125 is 23.75 interest only, and over here is 25.22. So again, roughly this, you got about $130, $140 difference there in the payment, which is nothing to scoff at. But again, it does come at a higher cost, 3.5 points versus 1.5 points over here. So it really depends. The bottom line is we're almost splitting hairs. If you need it, if you're $10, $20, $30 over and you need the interest only, then it's a no-brainer. But if you don't need it, give your borrower all the options, empower them so that they can make an educated decision so that you can be the ultimate loan consultant. Looking forward to helping you all structure your 40-year amortization and interest-only loans.
All right. Thank you, Jose. So it looks like we do have a question that came in here. We can pull it up on the screen here. And the question is, after the 10 years and the loan begins to amortize, will the interest take on the current rates considering the 40-year option?
The rate does not change, right? This is a fixed rate loan. So whatever is your rate will continue to be the rate. But what will change is that once the interest only period is over, then the loan will transition to a 30-year amortization, and whatever is owed, whatever is the principal balance, and remember, any interest, if you're paying interest, that's fine, but your principal balance does not reduce. So at that point, whatever you owe is going to be recast as a 30-year loan, and the payment that has to be made now will include principal as well as interest. So the payment will definitely go up, and most likely the investor would probably want to refinance. If they haven't refinanced, 10 years is a long time, right? They could have sold the property, or I'm pretty sure the rates will go down and you'll be able to refinance them out of that loan into maybe a non-interest only loan of 40 years or a 30-year loan if they really want to maximize the benefit of the rate and really start amortizing principal.
All right. I don't see any other questions, so I think we can go ahead and wrap it up. Again, yet another amazing tool to have in your tool belt here. Looks like there is another question that came in. Question is, can you make additional payments toward the principal during the interest-only period? If so, are there any restrictions or penalties?
Yes, you can always make payments towards principal. You can, they pretty much what they do is they send you the statement and they give you the option. This is your interest only payment. This is your payment if you want to pay principal, or they just give you a box where you can write in the principal amount that you want to pay and pay it. And then when the loan recasts after the interest only period is over, then you're obviously going to have a lower amount to pay. So a little bit lower payment if it makes a difference. But again, usually in this scenario, the best case would probably be before the 10-year interest only period is up and the loan transitions to a 30-year to refinance out of that loan.
All right. Okay. Well, thank you for the questions, everyone. And we'll go ahead and wrap it up. Remember, 11 a.m. Eastern every weekday, we do this show where we go through the live rates and then do a deep dive into a different loan topic. So we got a new topic here for you tomorrow. We appreciate everybody tuning in, and we will see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage